On August 5, the global financial markets were rocked by a shocking event. Japan's stock market experienced its largest single-day drop in history. The Nikkei index plummeted 12.4% in just one day, wiping out 4,451 points, a drop even steeper than Black Monday in 1987. In just a few trading days, the cumulative decline reached 26%. This sudden and massive crash not only shook Japan but also triggered a ripple effect across global markets. In its wake, South Korean and Taiwanese stock markets also tumbled by around 9%, while major U.S. indices dropped by about 3%. So, what exactly caused this financial storm? To understand the sharp drop in Japan's stock market, you first need to grasp the concept of yen carry trade. For a long time, due to Japan's extremely low interest rates, global investors borrowed large amounts of yen and converted them into higher-yielding currencies to earn the interest differential. However, this seemingly risk-free arbitrage trade carries significant hidden risks. When the interest rate gap between the yen and the dollar changes, this arbitrage model can collapse quickly. In March of this year, the Bank of Japan implemented its first interest rate hike in 17 years, ending the era of negative rates. On July 31, Japan raised rates again, while at the same time, U.S. inflation cooled, and markets broadly expected the Fed to cut rates in September. This series of actions directly narrowed the interest rate gap between the yen and the dollar, undermining the basis for yen carry trades. Investors began to buy yen in large quantities in the foreign exchange market to repay their yen loans, causing the yen to surge 12% against the dollar in just a month. During this financial storm, international investors, including Warren Buffett, played a significant role in fueling the situation. During the 2020 pandemic, Buffett began to dabble in the Japanese stock market, purchasing a series of high-dividend stocks. By 2023, Buffett had increased his investments in Japan's stock market, sparking a global investor frenzy for Japanese stocks. In 2023, overseas investors' net purchases in Japan's stock market exceeded 3 trillion yen, driving the Nikkei 225 index to a 28% gain in a single year. By March 2024, the index had broken the 40,000-point barrier, marking nearly an 80% increase. In a backdrop where Japan's economy had yet to fully recover, the Japanese stock market's historic highs were largely driven by international investors. However, as Japan's interest rate hikes and the expected U.S. rate cuts converged at a historic point, these international investors began to sell off Japanese stocks on a large scale. This triggered a market stampede, and in the rapidly falling market, many leveraged investments were forced to liquidate, causing a further accelerated downturn, a chain reaction that led to the historic disaster in Japan's stock market. After the crash, Japan's Deputy Governor Shinichi Uchida quickly stepped in, stating, "In times of financial market instability, there will be no rate hikes." While this news provided some short-term comfort to the market, the long-term outlook suggests that the Bank of Japan's rate hike expectations are likely irreversible. Meanwhile, the latest data from the U.S. Department of Labor showed a sharp drop in the number of Americans filing for unemployment benefits for the first time, marking the largest decline in a year and indicating a recovery in the labor market. This data contrasts sharply with last week, which triggered a wave of speculation about a U.S. recession. The impact on U.S. Treasury yields was significant, with yields initially plummeting, only to recover above 4%. However, in the long term, the market's expectation of a Fed rate cut is growing stronger. The probability of a 50 basis point rate cut in September has surged from 22% a week ago to 56.5% today. There is now over a 78% chance that the total rate cuts this year will exceed 100 basis points. The trend towards a U.S. rate cut seems inevitable, and it's almost certain that Japan's stock market boom is now a thing of the past. How things will play out from here remains to be seen.